Oyez, oyez, oyez. Anyone with business before the King's Justice of the Superior Court of Justice, attend now and you shall be heard. Long live the King, the Honorable Justice Hennessy presiding. You may be seated.
Good morning.
Good morning. The last thing for the plaintiff's case in this phase 3 is for us to tender and read in the discovery questions posed to Ontario and Canada. Now, I understand that this has been provided electronically over the weekend to my friends, and it is now being provided in hard copy to the court. What I propose is to ask that the discovery questions for Ontario and be read in as the next exhibit, and then the next exhibit be that of the read-ins in respect of Canada, and that I'm not going to actually orally read in the questions and answers. I think that's not a good use of court time. There is one question I would read in just for emphasis, but other than that one question, it would be my intention to just have them treated as though they were read in.
Okay. Counselor, you're content with that? Mr. Rankin, you're on your feet.
Your Honor, we have no issue with having the documents marked as the next exhibits. The only point that I'd like to make for the record is that from Ontario's perspective, the admissions given by Canada, which are being proposed to be read in, do not bind Ontario. So with that qualification, we have no issue with these exhibits being marked.
Thank you. And I presume you passed that on to Mr. Schacht.
Yeah, I mean, if that's what the law is, that's what the law is, and I'm not going, if there is a dispute about that later, it'll be a matter for argument.
Thank you. And you'll raise it if you wish to in submissions.
Yes,
Thank you.
yes.
Mr. Schechter, just for the record, both of these are going to be exhibit 26.
No,
No,
no. The discovery questions and answers posed to Ontario
Ontario,
should be the next exhibit, which is exhibit 26, I take it.
correct, yeah.
And again, by consent, the discovery questions and answers posed to Canada that the superior plaintiffs are submitting into evidence would be exhibit 27.
Thank you.
And
I
as
think
I,
Ms. Evans wanted to,
Only to say that we agree with Mr. Schachter's proposal to simply file them as exhibits without the need to.
thank you. Thank you very much.
right. The format that I used in these read-ins was similar to phase 1, where there's an explanation as to how the questions should be treated. A number of these questions were actually read in phase 1, and notwithstanding that the evidence in phase 1 is applicable to phase 3, I put them in again because they deal, I think, in the most part with respective Crown liability. And so you will see an explanation of that point at paragraph 7 of each of the discoveries, just an explanatory note that I'm reading them in again, some of them in again, and I've identified which are duplicates.
Yes.
The one question, and that's on both of the exhibits. The one question I would like to read in is the very last one in the discovery questions for Canada on exhibit 27. And I think this is an important part of our case. So it's question 666B as in Bob, and 666B deals with the August 1, 1900 arbitration award. And I am not going to repeat the question, but the answer is, the question at B, is, does Canada admit that in 1900, and in consideration of the agreement made with Ontario and Quebec to settle the arbitrations, it would forever take sole responsibility as between it and the provinces to pay the Robinson Superior Treaty annuity payments, with the proviso that Canada's commitment to Ontario and Quebec was only in respect of such annuity payments as would be based on payments of $4 per individual per annum. Canada's answer, agreed.
Thank you.
That then concludes the plaintiff's case.
Thank you very much.
Justice Hennessy, with your permission, we would like to split the examination of Professor Jack Mintz between myself and my colleague, Ms. McNamara. Ms. McNamara will go through the exhibits that we'll be entering and Professor Mintz's credentials, and then I'll be going through a slide deck with him. With your permission, my friends have agreed to the split examination.
No problem at all.
Thank you. Just, if we take a brief indulgence, I'd like to ask Professor Mintz a question about his swearing and affirming.
Thank you. Yeah.
Justice Hennessy, then I'd like to call Canada's first witness, Professor Jack Mintz.
Thank you. Please.
Please state and spell your name for the record, please. Do you swear that the evidence to be given to you, due to the court touching the matters in question between the parties shall be the truth, the whole truth, and nothing but the truth, so help you God? Thank you so much.
Good morning, sir. There's a guard there so you don't fall backwards, which we're all happy to have.
Yeah, I just had to make sure I don't keep bumping my knee on this thing.
Good morning, Professor Mintz. Just before we get started here, I saw that you brought some papers up with you. Could you describe for us what you've got, what papers you've got there?
Yes, one of them is the report that I wrote with Mr. Reardon called Determining the Value of Net Resources Revenues in the Robinson Treaty Territories, dated July 11th, 22, and November 15th, 2022, was edited with production numbers inserted.
Okay, and those are all the papers you have?
No,
there
sorry,
with
no, that's one. The other one is the SIR reply report by myself and Fred Reardon in response to the expert reply report of Joseph Stiglitz and David Hutchings, dated October 31st, 2022, and the expert reply report of David Hutchings, dated October 31, 2022. And those are the two things I brought up.
Thank you. Justice, before we get started this morning, I just wanted to enter a series of documents to go in as numbered exhibits with consent of the plaintiffs and Ontario. And those have also been provided both in hard copy and electronically to the court.
And is there any difference between what I have received earlier and these documents?
No.
Thank you.
So the first document to go in is the qualifications and agreement to the admissibility of the report.
Yes.
And I believe that brings us to exhibit number 28.
Correct.
And in this document, you will see that Professor Mintz is an economist qualified as an expert in public economics, corporate taxation, banking and financial intermediation, industrial organization, welfare economics, and microeconomics theory, with specific expertise in the taxation of natural resources and related government policy. The second document that I would like to enter as Exhibit 29, again with
I'm
consent.
just going to ask you to give me a moment to
Yep, no
catch up.
problem.
Go ahead.
Okay, the second document I'd like to have entered as exhibit number 29, again with consent of all the parties, is Professor Mintz and Mr. O'Riordan's expert report. Professor Mintz has given us the title, but I will go over it again. So that is determining the value of net resource revenues in the Robinson Treaty Territories, dated July 11th, 2022, and edited November 15th, 2022 to insert production numbers.
Thank you.
And then the final document is the SIR reply. So with consent, I'd like to have that entered as exhibit number 30. And Professor Mintz kindly gave us the title, but for the record, I'll go over that once again. So this SIR reply is the SIR reply report by Jack Mintz and Fred O'Riordan in response to the expert reply report of Joseph Stiglitz and David Hutchings, dated October 31st, 2022, and the expert reply report of David Hutchings, dated October 31st, 2022. And that SIR reply is from December 5th, 2022.
And I see you have handed up a slide deck. Will you deal with that at the end of the examination? Is that the plan?
Ms. Evans will deal with that
Okay.
at the start of her examination.
Thank you.
You are very welcome. Okay, good morning, Professor Mintz.
Good morning,
Could you please state your name for the record?
Jack Mintz.
Okay, and I understand that you have co-authored two reports. Is the report titled Determining the Value of Net Resource Revenues in the Robinson Treaty Territories your first report?
Yes, it is,
Okay,
as a co-author.
and you mentioned that it was updated for production numbers in November of 2022. I understand it was also redacted later. Why was that?
Well, the report was based on or included comments on report by Professor Bill, who unfortunately had to withdraw from the case and due to illness, from what I understand. And so all the references to his report were redacted from it.
Okay, thank you. And the second report is your SIR reply report, which was in response to Joseph Stiglitz and David Hutchings and David Hutchings. Is that correct?
That's correct.
Okay. And are there any corrections that you would like to make to either of these two reports?
There was a correction to a table, which I was going to refer to later on, with respect to the logging tax revenues, where there was I think a reversal in numbers. Instead of, it was type 2.3 instead of 3.2 billion. So anyway, I found that, had that corrected. And I believe there was another correction, but I don't recall what that correction was.
Okay, and that number correction, that will be part of your demonstrative PowerPoint, is
Correct.
that right?
Yeah,
Okay.
the other one didn't, so that's why I don't remember.
That's okay.
Yeah.
And so together, these two reports, they form the content of your opinion.
Yes, they do.
Okay. And the final question I have about this matter is a bit of a housekeeping procedural issue, which is that you signed a document to abide by Rule 4.1 of the Ontario Rules of Civil Procedure. And in sum, I want to ensure you understand that your duty is to do your best for the court today.
Absolutely, yes.
Thank you. And so I have a few more questions here to highlight your experience and provide some context for the court. And so the first is, could you please tell us about your education?
Well, I did an undergraduate degree at the University of Alberta in honors economics. That was my specialty at that time. I then went on to Queen's University. I did a master's in economics with a specialty in public economics, particularly. And then later on, after working a year in Ottawa for the Economic Council of Canada, which, by the way, I met my wife then at the same time. We went
Important
to
milestones.
exactly that one I never forget. I then went to England with my wife, and I did my PhD at the University of Essex in economics. With again, my specialty was in public economics.
Okay, and what was the focus of your doctorate thesis?
Actually, the focus was on what's called public-private mixed enterprises, which is kind of an unusual type of arrangement where back in the 1970s, governments, especially in Europe, but also in Canada, decided that their public enterprises weren't performing very well. And so then they decided, well, we'll sell off a bit of the shares and maybe that will put some discipline on the managers. And I was trying to write a thesis to explain, is there any value to doing that? And part of my thesis was focused on risk, because in countries where they have poorly developed capital markets, there may be a real value to the government providing some risk capital to companies. In a more developed economy, that question is not as clear because you have a very well functioning financial intermediary system that could provide risk capital as well. So you have to identify, what's the market failure. But the other interesting part of my thesis was looking at the relationship between the principal and the agent. The principal being, let's say, the government, but also private owners of the company. So you have two principals, and they're trying to control an agent, which is the manager or the operator of the company. And that in itself was actually quite unique because at that time there was very little theory developed looking at which some of it is coming back in recent history. In fact, when the whole question came up about Nexen being bought up by state-owned enterprises and state-owned enterprises, particularly from some of the countries in Asia being partly owned by markets in Hong Kong and things like that. Those were mixed enterprises. And the question is, how well do these mixed enterprises perform? And it was quite interesting that after almost 40 years since I wrote my PhD thesis, that this issue came back in droves. And in fact, I know that my thesis, there are elements in it that was looked upon at the Federal Civil Service when they were making decisions about the degree to which state-owned enterprises should be buying up Canadian companies.
And how is that relevant to economic theories related to sharing profits?
Well, it goes very much into the whole question of sharing profits because there are risks involved. And there's also another issue, which is called moral hazard, where an agent might have reasons, let's say, pecuniary benefits that might go to them by making decisions that may actually not be good for the principal, but is good for the agent. For example, like putting up nice fancy paintings up in the wall, or lots of luxury products that they might buy that add costs on, but then it reduces the returns that the shareholders get. And so those kinds of issues are really quite relevant to natural resources. And over the past decade, since actually about 2012, I've been writing a number of papers on the taxation of natural resources. And I go back to this principal agent concept, because the government actually is the principal that owns the resources that are in the ground. And it's the agent that, the operator that the government hires to work for them. And so there has to be an optimal contract set up between the government and the agent. And in fact, this is very much part of the whole question about how you end up taxing natural resource companies and how you are able to get revenues from them and the impact that that can have on their decisions. And so it's all very quite relevant, this kind of work to today's discussion that I will be having later.
And can I just ask a question? When you talk about the principal and the agent in the natural resource sector, and you say the government is the principal and the operator is the agent, does that presume the operator has been contracted by the government?
Yes, and that often is the case.
So the resource has been nationalized?
Well,
Like the mine, like
yeah.
if we take
well,
Northern Ontario, that instead of, I don't know, let's use old language, instead of Inco owning the mines, that the government owns the mines and they contract with Inco to run the mines?
no, actually, it's the government owns the resource in the ground.
Right.
Okay, and they want to have it, they may want to have exploration, they
Yes.
may want to have development, and then extraction of the resource.
Mhm.
And they have to hire somebody to do that work because the government doesn't have the ability to do that. And by the way, this doesn't just have to be the government. I'm talking about the government because, I was looking at natural resource revenues that the government raises. But it's also true for private owners of, freehold land. So for example, in Texas, you have a lot of the land that's not owned by the government, but it's actually owned by a private individual. And in principle, it could also be First Nations too.
Mhm.
I mean, it could be anybody that could be, owning the land or the resource. And then they have to hire somebody, which there is a contract effectively, hire somebody to undertake all the work. And so the company ends up usually owning the capital and engaging labor and having the responsibility with that. But then they make a payment to the owner of the resource for the right to extract the resource.
Right, but that's the relationship.
Right.
The payment by the operator back to the government. It's not in, when you're talking about taxation, it's not that the government retains an operator to do that work on its behalf in what I think of as the principal agent
Well, actually,
relationship.
yeah,
Well, they
sorry.
just open it up to the market and somebody buys it and pays a royalty or some kind of licensing fee in order to extract the resources.
Well,
Or am I missing something?
yeah, no, well, I guess, I'm being an economist, so I'm not necessarily the
And I'm
right
not.
person when it comes to law.
Okay,
But I can tell you from some of the countries I worked on, there's actually formal contracts, production agreements between a government and an operator. For example, just on Friday, I did a presentation to a number of mining and oil and gas companies by Zoom in Washington. And someone had asked me about production agreements because there's actually formal production agreements like in Nigeria and a number of countries where the government says, okay, you get this right, but we're going to write down in a contract, what we're going to be entitled to and some of the legal issues that, that you have to abide by. And there's a formal contract that actually that is written between the government and the private producer in that case. And of course, in the case of let's say a private producer, which could, like in Alberta, there is some freehold land, not a lot, but most of it's government owned. But freehold land in Alberta, where you have freehold land, you have a private owner of the resource. They will write a contract with the producer for, with respect to whatever rights and sharing of responsibilities that are involved. But, I will admit, I'm not an expert when it comes to the legal aspects.
thank you.
Sorry, excuse me. I have a technical issue.
Okay. We'll take a moment. We've just interrupted you, Ms. McNamara. Please
okay.
go ahead.
So Professor Mintz, I understand that you're a professor. What universities have you taught at previously and where are you currently teaching?
Okay, well, I first started, after I finished my doctorate, I went to Queen's University. And I taught there from 1978 to 1989 in the economics department. Although my expertise was in public economics, there were so many good public economists there that they were very short of industrial organization people. So I actually ended up teaching industrial organization, which I did enjoy teaching as well. So that's why I have some expertise in industrial organization. I also taught cost benefit analysis and some public economics. It wasn't completely absent. And then in 1989, I went to the University of Toronto and I joined the Rotman School of Business. At that time, it was just called the Faculty of Management. But I was also a joint appointment in economics, and I taught the public economics graduate courses in economics as well. I then, during that time, then after that, I was there until I joined in 1989 and I was there until 2007. And then I went to the University of Calgary, starting January 1st, 2008, to start up the new School of Public Policy at the University of Calgary. And I'm still teaching at the University of Calgary. I'm half-time as an employee with the University of Calgary. And I'm still teaching a course in tax policy to law and Master of Public Policy students. I've also been and I was also invited to be at 3 universities for various breaks. One of them was back in 1984 when I went to the University of Louvain in Belgium, where I had a postdoctorate fellowship that was given to me at that time, and I was there for about 8 months. Then at a later time in 2000 and I think it was fall of 2006, if I recall, I went to New York University Law School, and I jointly taught a course at NYU while I was on sabbatical for half a year. And then following that, in 2015, after I stepped down as the founding director of the School of Public Policy in Calgary, I went on another sabbatical to Columbia University, the law school as well, where I took a half a year to a little less than half a year, but half a year to be engaged in some research at that time, but I didn't teach at Columbia. So I've had those experiences as well as in terms of appointments at other universities.
Okay, and what is your current position with the University of Calgary?
My current position now is President's Fellow. After I stepped down as a founding director, I was the Palmer Chair at the University of Calgary, but that was relinquished when I gave up the directorship, and I ended up being appointed as the President's Fellow at the University of Calgary, which interestingly, I actually report to the Provost directly.
And Professor Mintz, forgive me, but what is a President's Fellow?
It's basically, it was kind of made up as a new position for me. But it's basically a research position, and I've agreed to teach one course during that time.
Okay, and I understand you're also a research fellow. You're a multi-fellow at the International Tax and Investment Center in Washington, DC, and you're also a research fellow for CES IFO in Munich, Germany. What is a research fellow?
Oh, again, a research fellow. In fact, I have many research fellow positions right
Okay.
now. But the one with both of those institutions, they just involve doing research. I have no necessary commitments to do anything, but at time from time I will write a paper. I have visited both, and in fact, right now I've been somewhat more involved with the Washington Institute, particularly because they have a lot of interest in mining and oil and gas taxation, which is an area of expertise.
And I understand you served and still serve on some corporate boards. Can you speak to that corporate board service?
Yes, that actually started when I became president of the C.D. Howe Institute from 1999 to 2006. At that time, and I was still at the University of Toronto, still teaching a course and supervising PhD students for 20% of my time, but most of my time was at the C.D. Howe Institute. I did get to know a lot of parts of Canada and business leaders across Canada. And then I started getting invited to be on corporate boards, the first one being Brookfield Asset Management in 2002, 2001. I forget the exact year now. And I was on their board for 10, 11 years. Then was invited to go on the board of CHC Helicopter, which ended up getting sold before the financial crisis, which was good for the shareholders. And that was that was my second experience. I was also invited to be on the board of Morneau Chappelle, in fact, by Bill Morneau, who later became a finance minister in Ottawa. And I stepped down from that board in 2020. But I also was invited to be on the board of Imperial Oil in 2005. And actually, I'm going to be stepping down at the end of April from that board after 17 years. But they have an age limit, so I'm hitting my age limit.
Okay, and I understand you were invited to become a member of the Order of Canada in 2011. Why were you invited into this role?
Actually, it was 2015. I became a member of the Order of Canada. I think it was a combination of the various things I did through my career. Back in 1996 and 97, I was a Clifford Clark visiting economist at the Department of Finance. It's a very high level position appointed formally by the Deputy Minister of Finance, but you work really with both the Minister and the Deputy Minister. And during that time, I chaired what was called a really boring title, which was actually I selected because I wanted to make it boring. It was called the Technical Committee on Business Taxation, because I wanted to kind of play down the work. But it was basically a business tax reform panel that was made up of 9 people through the country with different backgrounds, accounting, law, and economics. And we came out with a major report at the end of my time at the Department of Finance. And that report actually led to significant tax reform in Canada, corporate tax reform. So that was one aspect in terms of what I did. As I mentioned, I was also president of C.D. Howe Institute, which also was a fairly prominent appointment at a later time. And also, I know that the creation of the School of Public Policy in Calgary was another aspect that led to the appointment in 2015. So when I stepped down as director on July 1st of 2015, I was also given a member of the Order of Canada, and officially it stated for my contribution to fiscal policy in Canada. And also I did a lot of work around the world for the World Bank and the IMF. I visited many countries with the kind of work that I've done, which included various corporate tax reforms in various countries, also some areas like fiscal federalism and a few other issues. But I've been to a long list of countries undertaking reform, and and actually, in some cases, pretty successful ones, I must say.
You mentioned consulting work for the World Bank, the IMF. Can you describe some of the consulting work that you did?
Well, I think there were, as I mentioned, there were a number of them. The very first time I went was back in 1987, when I was invited by the Public Economics Group at the World Bank to work on some theoretical issues and important in terms of policy to what the World Bank does. And in particular, they wanted me to work on tax holidays. These are kind of like temporary corporate income tax holidays that are given to businesses in various countries. They tend to lead to a lot of leakage of tax revenue for governments. And, a lot of governments tended to have them, but both the IMF and the World Bank were concerned about many of these tax holidays that tended to be in less developed countries to attract foreign direct investment. But they were concerned about the deficits that these countries had and the impact. And so the paper I wrote was actually, I noticed that a lot of people were modeling tax holidays incorrectly in terms of how you would measure what's called the effective tax rate on capital. And what I did is I developed a new method or a proper way. I went back to first principles and developed the appropriate way of trying to evaluate tax holidays. And in fact, that work got published in academic journals after that point. And then after that, the World Bank and the IMF asked me a number of times to go around to various countries to help them with corporate tax reform. Basically trying to limit these tax holidays or get rid of them. And then maybe undertaking a significant corporate tax reform that would still encourage foreign direct investment without losing revenues. And a good example of that is I went to Bulgaria in 1998. This is after I was finished Department of Finance in 96 and 97. Bulgaria had a terrible devaluation of their currency. They had huge deficits. The IMF was putting a lot of pressure on them to get rid of their tax holidays that were costing them a bundle of money. And I went with someone else from the IMF. I was representing the World Bank, and we worked out a package of corporate tax reform for Bulgaria that ended up lowering their corporate income tax rate from 38%. And they, in fact, they went beyond my report. We recommended 22%. They eventually went to 15%. But the main point is that I'll never forget, I told the Deputy Minister of Finance, you can get out of these holidays by just saying that they can still have the holiday, but they get an income tax exemption up to the amount of capital that they spend, which is kind of like giving expensing for capital and under the corporate tax system. And so what happened is she said, "Oh, that's a fabulous idea." So that's what they did, and they got out of all their holidays. And even though the investment promotion people were worried that they were going to lose foreign direct investment, the opposite happened. A lot of foreign capital came into Bulgaria after that. So it was viewed as being a very successful reform as a result.
You've touched on this a little bit here with your work in Bulgaria. Could you describe the work that you've done within Canada, the federal and provincial governments, and also other governments?
Well, I've been on running panels and being a consultant on tax reforms over the years in Canada. It started in 84 to 86 when I went up to Ottawa for 2 years to the Department of Finance. And at that time, in the May 1985 budget, the federal government had put out a discussion paper to restructure the corporate income tax. Again, the usual principle: lowering rates, broadening the tax base, improving neutrality, less interference, by the tax system and business decision making. All those sorts of things that economists like or tax policy people like to talk about. And that paper actually I wrote that went out with the budget at that time. And so that was the kind of the first venture I had. But then I worked, after that, Saskatchewan asked me to help them with reforming their potash royalty and their uranium royalty around 1987, which I did. In fact, they made quite significant changes to improve their royalty systems. I've also went back to Ottawa, as I mentioned, as Clifford Clark as an economist in 1996 and 7, when we did the report, for corporate tax reform, business tax reform in Canada. I then have also worked with a number of provinces like Ontario, British Columbia, Prince Edward Island, when they looked at reforming their sales tax systems, going from retail sales tax to the HST. And I was involved in some of that work. I was also involved in Alberta in 2007, before we moved to Alberta. The government asked me to run a panel on savings. The government said we want to get some advice about how we should save and what kind of investment policies we should be following. We did a report for the Alberta government at that time, and then they decided they'd rather spend rather than save, but that's what happens sometimes in politics. And then I've also been on a number of other panels, including in 2015, I was on a panel on healthcare innovation that Rona Ambrose, when she was the Minister of Health, appointed. I was a member of the panel. I didn't chair the panel. It was chaired by David Naylor from the University of Toronto. And so I was on that panel. And I've also been on various advisory panels, including I chaired the Alberta Premier's Economic Recovery Council that was appointed during the pandemic to help develop a new strategy, economic recovery strategy after the pandemic, which ran for about 2 years, and that one as well. And right now I'm on the Minister of Environment's advisory panel in Alberta with respect to climate change policy.
Okay, and I just have one last question for you here, Professor Mintz. You have specific expertise in the taxation of natural resources. How did you come to that expertise?
Well, actually, it probably goes back to my Alberta roots. When I was an undergraduate, I was very lucky after my second, third, and fourth year to work 3 summers at the Budget Bureau in the Alberta government. And at that time, I really started getting involved with oil and gas as an issue, in terms of policy, at that time. And so that was my first introduction. And so as a result, ever since then, I always had an interest in looking at non-renewable resources. And so that was really the start of it.
Thank you. I will turn things over to Ms. Evans. Continue.
Professor Mintz, I understand you've prepared some trial demonstratives in the form of a PowerPoint presentation for today's testimony. Do you have a copy of that with you now?
No, I'm going to need one.
Okay.
Thank you.
I believe that the court has a copy of this already,
I have it. Thank you.
and all of my friends have copies. So Professor Mintz, I'll bring a copy up to you then. Justice Hennessy, I think our usual approach has been to mark a document like this with a lettered exhibit number, at least until the end of the witness's testimony, to ensure my friends are agreeable to that.
I'm still wondering why we have that approach, but we don't need to mark it twice, do we? Okay,
This is
Oh.
relatively short. I think the reason why you would need to mark it twice is if there is material in here that perhaps is not in the report, or that is something new, then it probably should wait till the witness testifies. But if my friend can say there's nothing new in here, let's just mark it as Exhibit 31.
let's go.
Thank you. We'll mark this as exhibit 31 then.
Okay, great.
While we're on the topic of exhibits, I'd like to mention that we had intended to pass up a very brief errata correcting 2 typographical errors with respect to numbers in the report. We don't have a hard copy of that right now, but we'll get that after the break and then mark that as an exhibit as well.
Very good, thank you.
So Professor Mintz, I'd like to start going through these trial demonstratives then and have you explain for us some of the key parts of your opinion in your report. So perhaps we could start on your slide 2, which is outlining your assignment. Can you please outline for us your assignment, specifically with reference to which parts of the report you can testify about and which parts of the report your co-author, Mr. O'Riordan, will be testifying about?
Okay, we were asked to, sorry, Justice, we were asked to look at 6 specific areas. Actually, I can see this. Oh.
Do you have a problem with it? We'll fix it.
No, it's just kind of moving around.
Yeah,
And,
your indulgence while we sort out the
you know, there's a,
presentation.
but I can look at the hard copy, so I'm good.
Well, if you can just bear with us for a moment, it would be best if we could get the screen version corrected, and we'll just take a minute to. Thanks for your patience. If I could just ask the court's indulgence for a moment to work out the check. Thank you very much.
It's worth the time.
Thank you.
Technology is great when until it doesn't work.
We have a bigger audience than just who is here. Okay. Control and down.
What I'll do is I'm just going to
Think you've got it.
Yeah. Thank you.
Can we go to slide 2 then? Thank you very much. And I'm sorry for that delay. Professor Mintz, you were going to take us through this slide 2 where you explain the assignment and how you split it between, or how you're going to split your testimony between yourself and
Right.
Mr. O'Riordan.
No, I wouldn't say that our report was split because we were both involved in writing the report. I'm going to be covering specifically the first 2 topics. The first one being related to spectrum, which is a federal net resource crown revenue, and so I'll be covering that myself and that part of the report. The second on the theory and methodology of quantifying natural crown resource revenues. That one I will be dealing with as well. I should mention that we were not asked to deal with Ontario revenues, so our focus is on federal revenues only, and expenses. The third one on the theory to ascertain the value of resources, that one is shared between Mr. O'Riordan and myself. I will be specifically dealing with some of the limitations in trying to use this approach for determining how to augment the annuity. The fourth one on the appropriate share of net crown resource revenues, that will be dealt with by Mr. O'Riordan.
Can I just ask you, when you say the value of resources, is this your comment on the economic rent
Yes,
approach?
yes.
Thank you.
The fifth one on the relative wealth of treaty beneficiaries and settlers, Mr. Reardon will be reviewing that part of the report. And the sixth item, opinion as to economic factors and principles that should apply to the court's determination of the appropriate amount of the natural crown resource revenues to be dispersed. Those principles will be both discussed by Mr. Reardon and myself. But I'll give you in the next slide, in slide 3, I'll give you a clear reference in terms of what pages I cover of our report and what pages Mr. Reardon, and that Mr. Reardon will cover when he gives his testimony. He'll say what exactly the pages that he'll be covering.
All right.
Thank you, Professor Mintz. So if we move on, then your third slide I see is just explaining the 2 reports that you wrote, and I think we've been through those already. So perhaps you could then move on to your 4th slide, where I think you set out more specifically the areas that you'll be speaking on.
Yes, that's right. So, you know, as it's been already acknowledged, you know, I've written the report with Mr. Reardon, where we jointly wrote the report, as well as the SIR reply report that's already been referenced. And I've already mentioned that you know, we focus on federal net crown resource revenues, leaving other experts to deal with the Ontario ones. And I will be specifically commenting on these specific issues. The first one being federal net crown resource revenues. I'll talk about conceptual issues, which is on pages 8 to 19 of the report. Spectrum, pages 21 to 30. The logging tax revenue that was given as a credit under the federal corporate income tax, that's pages 30 to 32. Then there's some specific issues related to the estimates of net revenues in the Robinson Superior Treaty Territory, which is on pages 33 to 38 that I will discuss. And then limitations of the value of the economic rent report approach, which is pages 46 to 58 of the report. And then in the SIR reply, specifically on spectrum and logging tax revenues, that's in pages 6, 7 of the SIR reply. So those pages I'll be specifically dealing with myself today.
Thank you, Professor Mintz. So then I see in your next slide, you just have a sort of a table of contents kind of guide there. And I understand the first topic you'll be addressing is the conceptual issues. Would you like to start to take us through your slides on that?
Okay, well, let me begin now with net crown resource revenues. As they arrived at determining revenues. And I'm going to quote, which is what I understand was a decision from the first stage. And so, Justice Hennessy, I'm sure you know this line very well. Arising directly and closely related way to the use, sale, or licensing of land, which could include the waters in the treaty territory, and subtracting expenses incurred to collect, regulate, or support resource revenues. And I think there's been a fairly, on many of the things, I think there's been a very common view, I think, of the experts, as I interpret it, with respect to mining resources, forest, hydroelectric fees, and land sales in terms of being included as resource revenues. I think there is some dispute about spectrum, and we'll be getting into that later on, as whether that should be included as part of the issues here. Subtracting expenses, that includes things like the administrative cost to collect the revenues. I think resource revenues. I think everyone would agree those things should be included. Regulation, I think, regulate is, I think, also fairly clear. Supporting resource revenues is an issue I'll get more into later on, because you can take different definitions of what one means by supporting revenues. You could take a very narrow definition, or you could take a wider definition, which I'll get into later on.
I'm going to ask you a question and I want to make sure that you don't think that I will personally take anything from it. Is the use of the word support an economic term or a term used by economists?
You know, it's a good question.
Or was it just made up?
I wouldn't say it was just made up. You know, I think there's a I think there's an important connotation, because at least when I think of support, there are things that are expenses that try to make it viable to develop the resources that governments will do. And those things are kind of indirect. They're not necessarily spent, directly in terms of collecting the resource revenue or regulating the industry. But it's expenditures that are needed in order to make sure that the industry is going to be viable. So to take an example in mining.
No, it's okay.
Yeah,
What I
just
what I
giving
want to
my
ask from
particular-
you is there, is there some accepted, some state of art understanding of what that means, or is that what you take it to mean?
I think it would be what I take it to mean,
Okay,
because I'm not sure if there is an art or a
Okay.
state of thinking
okay.
that would define it.
It's not necessarily a defined term in the economist's dictionary.
No,
Okay.
at least from what I know.
Okay, thank you.
Thank you. Professor Mintz, I think you were ready to take us to your next slide, perhaps describing different
Well,
types
just,
of resource
Just
revenues?
one very quick point,
Sure.
which is the last point, which I think there's been pretty well agreement even amongst the experts on this point. And that is natural crown resource revenues can be positive or negative. I mean, expenses tend to be, fairly stable over time. But we know with volatile prices, revenues can go up and down all the time. And so it's possible for net crown resource, NCRR, net crown resource revenues to be negative at certain points, because the revenues coming in is less than the actual expenditures to be made. And I'll talk about this later on, but I think it's just something that we have to keep in mind as we go through this, and whether those negative amounts should be included as well.
Thank you. So your next slide, which my friend has brought up on the screen, is about resource revenues, types of resource revenues and the relationship with economic rents. Can you take us through that?
Okay, well, I think this is, the next part is going to be kind of a very key part of what I want to talk about. And that is, what do we mean by, resource rents or economic rent, which I think is really an important concept here. And how governments may try to collect those rents or capture those rents, as I've personally written about. So first to note, private producers will often pay taxes and other levies to governments for the right to extract resources. I'm going to get into this issue about what we mean by taxes versus royalties and other things, because that's an important distinction as well. But the main point is that the private producers end up making a payment to the government for the right to extract resources that the government owns in the ground. And that's particularly in the case of Canada, since governments end up owning most of the resources that are in the ground, including in Ontario. Now, to collect those resource revenues, there's different types of levies that could be imposed by governments as a way of collecting it. And I guess Justice Hennessy, this goes back to an earlier question you raised, because sometimes you could actually have private contracts between the resource producer and the government, as in these production sharing contracts. Sometimes the governments just have a generic system that applies to everybody that wants to exploit the resource. But the way that the system operates, and and I can say this from understanding the oil and gas sector, particularly given my experience over the years, is that the key point is that a private producer is allowed to extract resources if they get a lease from the government to go ahead and look for the resource and then have the right to extract it. And the government will have a system of collecting rents or collecting revenues, sorry, from the development of those resources. And the types of various payments that could be made could include royalties or fees as a percentage of the value of production or revenues. It could be royalties or fees as a percentage of profits. And I'm going to come back to this, but I call them profit-based royalties. Some people just like to call them taxes and not royalties, and I'll get back to that point later on. It's actually a very important one. And then there are payments that are based on the unit of output, and then the final one are lease or bonus payments. And lease or bonus payments are kind of like the same thing as lease payments. When somebody signs a contract, let's say if you own the resource, you sign a contract, you get a payment at that time, right up front, before, at the time the contract is signed, and that's kind of done at the beginning of the process, when companies end up developing the resource, and so that's another form of payment that governments get.
Can we move on then?
Yeah, I think we can go on to slide 8. Then I want to go now specifically into these notions. And I'm going to start with, what do we mean by economic rent? And this is a really often tricky question. And in fact, even amongst economists, there's a lot of debate about economic rent. They don't question the fact that there is potentially economic rent. I think everyone agrees with that. But there's a debate about how you even arrive at it, or even to what extent how important it is. And I'll come back to that in a moment. But the definition of economic rent, you can think of this kind of like the surplus profit. Some people call it excess profit, that is earned after you subtract off all the opportunity costs, or all the costs of using labor, capital, and other inputs used in production. And I'm going to go into this in quite detail in a moment. So, I'll leave further comment to later. But that's a concept of economic rent. And the key issues is this concept of opportunity costs of using inputs in production. Now, royalties, fees, and taxes on the value of production and output and profits are ways that governments try to capture rents, but they're not necessarily rent taxes. In other words, they don't apply directly to what you might define as rents, but they may be ways of trying to capture rents. And I'll show you an example where that will actually happen. But I think it's very important to understand that often the way that governments collect resource revenues is not exactly the same thing as a rent tax, as a pure rent tax. And I'll get into more detail about this later. So I think maybe we can go to slide 9.
And I think this is where you start getting into some more detail. Is that right?
Yes, that's correct.
Maybe you can take us through that.
This is going to be slide 9 and slide 10 are probably the most important slides, I think, here. Actually, I should tell you one kind of story that illustrates why this concept of economic rent is so difficult. My very first publication was a really exciting one called The Measure of Rates of Return to Canadian Banking.
Well, let's all say we have different measures of excitement.
Which I did for the Economic Council of Canada, and there's a whole story behind it, but we won't get into it. But the main point of this work that I did, and this was the year between my master's and my PhD, when I did this work, was to try to estimate economic rent being earned by Canadian banking. And I remember the referee reports that were very positive of the work I did. But they all raised an issue about how do you define economic rent? And how do you get to it? And how do you actually empirically try to measure it? And in fact, some economists will even argue, well, there is economic rent, but actually ends up getting dissipated because people, move in and they end up producing it and they make the economic rent disappear. And so there's some economists who have argued in the past, and I had this in one of the referees saying, well, maybe there isn't really that much excess profits earned by banks because you can get enough entry coming into the industry to dissipate it. So that's why it's very important to think of what economic rent is. I think what most people would agree, and I think all of the experts would agree on this, is that natural resources that are in the ground are a source of economic rent. May not be the only source, but it is a source of economic rent. And the reason is it's fixed in supply in the following sense. Take like mining ore. It's sitting in the ground. It has to be discovered, and somebody has to spend money to develop, develop the mine shafts and everything else that are needed to extract the resource once you think you have enough there to extract. And then you extract it and then you try to sell it to the market. But the ore itself sitting in the ground is fixed in supply. And that is the source of economic rent. And you can't just simply it's there. It's a certain amount that's in the ground that cannot be taken, you cannot add to it and you cannot subtract from it per se. You can subtract on it by taking it out and selling it, and it can't be and you can't be replacing it, but it is just in the ground. It's just a fixed amount that's in the ground. What makes it variable, of course, is the actual process of exploring and developing an extraction, but whether you can actually bring that ore to the market or not. And so that is a source of what's economic rent, because it's difficult to replicate. You can't replicate the ore that's sitting in the ground. So I'm going to give an example which was in the paper, but an example that,
When you say in the paper, you're referring to your report?
yeah, report,
Thank
which I really, I'm just saying that, the numbers are actually identical. But it's just to give a sense of how this works. So suppose you have it could be forestry, it could be mining, whatever. And let's say you have a company that gets revenues from, selling its output to the market, and I'll assume it's $2 million that it gets per year. And there's a cost of hiring labor. And that's what you might think of as the opportunity cost, the wage costs, or the payroll costs that you have to hire people. That could be prospectors, it could be people working in the mine shafts, it could be people helping deliver the market, the product to the market. I'll assume is $250,000. And then there's some other material costs and energy costs, which are kind of like current operating costs. That's another $250,000. So if you subtract off those labor and material costs, you're left with kind of a gross profit of $1.5 million after you subtract it from the 2 million. And then there's something called the opportunity cost of capital. The others are opportunity costs as well, but you can measure them because the wage rate and the cost of energy and things like that. Those are easily observable. But the opportunity cost of capital is not as easy to observe. And I'm going to explain that on the next slide, exactly what those components are. But for here, I'm going to assume it's $1.4 million. And then when you subtract that off, you're subtracting off all your opportunity costs of labor, materials, energy, and using capital, and you're left with economic rent, which is $100,000. And that really is the value really of the ore that's sitting in the ground, or the trees that are on top of the ground, or rooted in the ground and cut and then sold to the market. So that's what goes to the fact what economists call factors of production, to the inputs. That's the input that's fixed in supply that's kind of the leftover economic.
That's what goes to the
leftover profit.
shareholders.
That will, it could go to shareholders or governments could tax it if
Right.
they can. Well, what I should say is that it would be the economic rent that would go to the natural resource if that is the only fixed factor. Which goes to the last point I make on the slide, which is very important. And that is there could be other fixed factors in production. And an important one is managerial entrepreneurship, let's call it. Not all entrepreneurs or not all managers are the same. For example, if you're going to have a hockey team, there's a big difference in getting a Wayne Gretzky compared to some other players. If I was running a hockey team, I'd like to have at least a few Wayne Gretzkys on it, so I could be on top of the standings. And then, of course, I end up paying a lot of money to Wayne Gretzky in order to get him to play in the hockey team. And so that's he's not easily replicated. His ability is not easily replicated, and that's true of managers too, or the operators, that they actually may be a source of economic rent as well, because their ability is fixed in supply. You can't just replicate Elon Musk's all the time, or people like that.
Ben, I think you were going to explain for us that $1.4 million in your example
Yes, this
being
is-
the opportunity cost of capital. Can you take us through that?
Yeah, so this goes to now slide,
This is slide 10, I believe we have
10.
opportunity cost of capital, slide 10.
I wasn't looking at my hard ones. Okay, slide 10. Oop. With a technical problem. Okay. All right, slide 10. So here I'm going to actually break down this opportunity cost of capital and try to, I hope, explain it as clearly as I can. And as I said, this is not an easy concept. Even economists sometimes get wrapped up in trying to think through what exactly this is. So capital costs, first of all, what is capital? Well, capital is the money that you spend on machines, purchasing land, the lease, which is the depletable property, the structures. It could include inventory. These are all different expenditures you have to make in order to run the business. And in this example, I assume there's $10 million in invest capital needed to be funded to provide all these things, to buy all the things that are needed, all this capital structures, and the machinery and inventories and everything else
Can I just
in order
interrupt
to run the business.
to say we're still talking about that same example you had before where we're theoretical revenues of $2
Right.
million. So this example here is following up on that.
Yes,
example?
exactly.
Thank
These
you.
are exactly the same numbers. It's just now I'm breaking it down into more detail. So you make an initial investment of $10 million. But in order to keep surviving as a company and continuing extracting resources or cutting trees or whatever you're doing, you have to sustain your capital. I always like to take this as an example. You have a structure, let's say, made up of some wood or bricks, and every year some bricks or wood breaks down. So you have to put in new bricks and new wood in order to replace that capital. That's called depreciation of capital. And you have to do it at the prevailing prices that you got to buy that capital at. And so I'm going to assume that every year, this is just for this example, that the capital depreciates by 10%. That's how much the bricks fall out, or the machine, ends up needing to get fixed and to make it back into proper order. So that's your sustaining capital in a sense to keep the business going. And at 10%, that means you have a depreciation and I'm including depletion here and amortization because that's the categories that it's called of $1 million. Now depletion actually is a little different. It's the property that you bought with the reserves in the ground. And
That's
as
the
you,
ore.
the
it's going
ore,
down.
right? And then as you sell ore, the value of those, that property that you bought, which had the reserves is falling away. It's declining.
Mhm.
And so that's what depletion is. So it's kind of like the depreciation of a machine and the structure, but it's a different type of depreciation. It's a depletion of the resource that was in the ground. So I'm including that as part of the $1 million. And then, but then in order to fund this capital, you have to raise capital. And you raise capital through financing. You might go to a bank and you borrow bank debt. Or you might issue bonds to the international market, or to the local market, the national market. And in the case of debt, we pretty well know what the cost of capital is, because that's the interest rate on that debt. In fact, lenders may feel that company might go bankrupt, so they may ask for a higher interest rate than, let's say, a government bond, where a government bond might be viewed as less risky or almost zero risk, because we know that the government will pay the bond back. Unless you're Argentina, then it's a little different. But in the case of Canada, with a AAA rating, I think people have a lot of confidence in government bonds, including Ontario's. But in the case, but you can observe the interest rate, and that's in this case, I'm assuming, let's say half of that $10 million is financed by debt at an interest rate of 5%, and so then you end up paying $100,000 in debt interest expense as a result. I think that's right. And then there's the cost of equity, and this is the tough one, because what is the cost of the opportunity cost of equity? Well, the only thing you observe in terms of what shareholders get is the profit that's paid to them. And going back to your question, Justice, that profit, part of it could be economic rent. And part of it could be what you might call the normal profit, or the profit that's needed to compensate equity owners to invest in that company versus investing in another opportunity with the same risk involved. And it's very important, that comment, same risk involved, and trying to find comparable risk. Well, going around trying to find comparable risk is not that simple, but that's the concept, conceptually, of what the opportunity cost of capital means. It's that part of profit, the normal profit, that you need in order to attract financing from the equity owners. Otherwise, they won't invest in the company if they don't get enough money. And I'm assuming, including risk here, I'm assuming that cost is $300,000 on that capital. And so when you total up the opportunity cost of capital, which includes depreciation, depletion, amortization, $1 million, debt interest expense of $100,000, the opportunity cost of equity financing, which is another $300,000, that adds up to 1.4 million. So if we go back to slide 9, see where I wrote opportunity cost of capital, 1.4 million. That's all those components that I just explained. And then after subtracting off the opportunity cost of capital, we get the economic rent value.
Professor Mintz, just going back to that slide 10, I just note that there seems to be a missing zero at the total capital cost, the last number in that chart. We're just missing a zero on the end. Is that right?
Yes, that's
Yeah.
right. Oh, I didn't notice that.
Yeah.
Okay.
Can you tell me where?
So if you look at this slide 10, which is in front of you now, the
Yes.
bottom right corner, total
Yes,
capital cost, there should be a zero on the
Oh,
end. It's
got it.
Apologies
1,400,000.
for that.
It's just a
Got it.
typo. Just let me interrupt for a minute, Professor Mintz. It's 11:30 now, and I wonder whether the court or the reporter need a break. I think we could go through the next couple of slides, maybe take another 15 minutes, or we could break now.
Take the morning break.
Thank you.
Thank you very much for taking the break.
All rise. This court will recess for 15 minutes. This court will now resume. You may be seated.
Professor Mintz, I think you were just finished up on slide 10, am I right? And can we move then to slide 11?
Yes, I can. I just want to make one small correction, although it doesn't really matter to the numbers I gave. I accidentally said that the interest rate on the debt was 5%. It was 2%. It was $100,000 divided by 5 million, which is 2%. The opportunity cost of equity financing is 300,000 divided by 5 million, which is 6%. When you, given it's 50-50 financing, the average is 4%, which is the $400,000 in the total cost of financing, not including, excluding the depreciation factor.
And
I
these are-
just wanted to clarify that.
And these numbers are just with respect to your illustrative example here.
Yeah,
Yeah.
I mean, it doesn't, it was just, it's not terribly relevant,
Thank you, though. I appreciate that.
but I didn't like saying something incorrect.
Great.
So now I want to go to slide 11, and these are exactly the same numbers, but if you notice in the previous example, there was no taxation in it. There was no, or royalties, or it was nothing. The government didn't do anything. In fact, the economic rent, as I said, actually doesn't necessarily come from the ore. It could come from managerial ability and anything that's a source of fixed factor. So I'm going to take the mining profit tax as an example. And Ontario's mining profit tax applies not to the value of production that you find in a number of countries, but actually in Canada, actually most of the provinces apply the mining tax to revenues net of operating costs and depreciation and depletion and amortization costs. And so in that case, mining profit, once you subtract off operating costs and depreciation, 500,000 and $1 million respectively, you get a mining profit of $500,000 that's subject to the mining profit tax in Ontario. And then taking the profit tax rate of 10%, which is $50,000, and then subtracting off the debt interest cost of 100,000, the opportunity cost of equity, it's exactly the same numbers as in slide 10. Then we end up getting economic rent of $50,000. And if we go back momentarily to slide 9. Right, the economic rent was $100,000 before you put on the tax. Now we put the mining tax on at 50,000 and the economic rent drops to $50,000. And so it captures the rent in that case. The mining tax captures the rent, at least half the rent. The other half of the rent would go to the owners of the owners of the capital that are providing the operator or the agent, as I like to call it sometimes. Now we'll go to slide 11 or 12. And this case, I'm going to take the forest stumpage fee. And unlike the mining profit tax, which kind of applies to kind of like profits gross of interest expense, the stumpage fees are actually come off the top. The company gets revenues, but then there's a stumpage fee that has to be paid based on volume, and there's a price adjustment involved with that. And I'm going to assume it's $100,000. And assuming now, so that leaves like $1,900,000 in net revenues after subtracting off the stumpage fee. And then the operating costs, just exactly the same numbers as before, the $500,000 depreciation and is $1 million. The debt interest cost of 100,000, the opportunity cost of equity, 300,000. Subtract all those things from 1.9 million, and the economic rent now is 0. So in this case, the government, through the stumpage fee, just in this illustrative example, is actually getting all the economic rent by putting on the stumpage fee. Now, an interesting question, and just as you might be thinking of this, is what happens if the economic rent is negative? Which is a good question to ask. And so when we go back to the revenues, let's say the revenues were 1.9 million instead of 2 million. Then economic rent will be minus $100,000. So what will happen then? Well, what will happen is that the company will say, we can't cover all our costs. We can't cover all the depreciation, the debt, and the opportunity cost of equity financing. So we're not going to do this project. And in fact, it'll end up saying, we're no longer going to do the investment. We'll go elsewhere, or we'll only undertake investments that make at least $2 million in revenues. Otherwise, we can't go ahead with the project. So that's when actually both the mining profit tax and the stumpage fee, they don't just tax the economic rent, but they also tax the normal profit. And if the normal profit, or the profit that would go to the shareholders to cover their cost of capital, and if it takes normal profit too low, that they can't cover their opportunity costs, then you're going to affect investment with the stumpage fee or with the mining profit tax. To put it in another way, going back to this example, suppose we keep the revenues at 2 million, but let's say the government decides to double the stumpage fees from 100,000 to 200,000. Then in that case, economic rent will become minus $100,000 again, just the same thing. But the government's absorbing not only the economic rent, but it's also taxing the normal profit that goes to shareholders. And so the shareholders can't cover their opportunity cost of investing elsewhere. So they'll decide to cut back investment and only invest in those projects that bring them sufficient revenues in Ontario, or they could completely abandon Ontario and go to some other jurisdiction where they can get a better return on their capital that would cover their opportunity cost of capital. So that's why both the mining profit tax and the stumpage fee, you don't capture the rents. But if they go too far, you can drive out investment. And I think that's a very important message here.
Professor Mintz, you've used the term a couple of times, the normal profit. Can you just explain for us one more time what the difference is between normal profit and what we've heard is the surplus profit of economic rent? Can you go over that again?
Well, you can think of the firm, in this case, the firm makes, there's a total profit that's being earned. And the total profit, if we go back to page 9. Well, actually, yeah, if we go back to page 9, it's kind of like a gross profit for the opportunity cost of capital. But if we subtract off depreciation, we subtract off interest, that's profit that's going to the shareholders. And that will be 1.1 million. So it's 1.5 million minus 1.1 million, which is $400,000. That's the total profit that goes to the shareholders. Some of that is economic rent, which is 100,000, but 3/4 of it, $300,000, is which covers the opportunity cost of investing in that firm versus other opportunities. And that $300,000 is the normal profit that goes to just satisfying the shareholders to make an investment in the firm.
Can we look at slide 10? Because I think that's where you show that in your chart.
Yeah,
here,
that's the
the
300,000.
300,000.
Yeah, I was trying to go back to the earlier one, getting economic rent. But if you go to slide 10, the opportunity cost of equity capital, that's the normal profit, is $300,000. That's the profit that you need to attract the investors to invest in capital.
Can I see if I understand this, that $300,000 when you normal profit, it's what they could get somewhere else.
Yeah, including of equal risk, an investment
equal
of
risk.
equal risk.
So they have a decision to make on Monday morning. Where do I put my financing money with which I want to earn a profit? And I have 5 choices here, and I can earn 300K in any of these 5. And you say, but to attract them, you need to offer them another 100K.
No.
Or if they get another 100K, then that's called a surplus profit.
That's the economic.
That's the economic.
So that you need the 300,000 to get them to bite the apple.
Come to this sandbox and play in this sandbox.
The only thing is that, of course, mining companies are operating around the world and there's economic rents around. And I'll talk about more of this later on, but if they can get some economic rent in other parts of the world, then they would like to get some economic rent in Canada too, in order to invest in Canada.
That's not part of the
But
three
that's
hundred.
not part of the normal profit, right?
Okay,
But that's kind of a different consideration. But if we think of a competitive assumption, which is what Professor Stiglitz, for example, assumed, then as long as the company can cover its normal profit, it will make the investment. But if it can't, if it can't cover its normal profit, it won't make the investment. But the point is that the shareholder profit, that $400,000, is really going to two things. It's subject to tax by the mining profit tax, the total 400,000 in a sense. But some of it is normal profit and some of it is economic rent. And if there's enough money on the table, the company will go ahead with the investment. But if there isn't, then it will decide not to invest. It has to cover.
well, we're
that
not
300,000.
raising, but there might be other reasons why investors choose one investment over another. That might not have to do with dollars.
Well, usually we think of shareholders when they make investments around the world, they do want to get a return on their capital. And if they don't get at least the minimum return,
Right.
then they're not going to make an investment. So it is money involved in that sense.
I just said, when they have a choice of five.
Yeah.
They may make their choice for other reasons than dollars. They can get that same return 5 different places.
Um,
Well, it's just from, that's a non-economist reading the paper
Yeah.
about.
well, you might be
Yes.
thinking of things like political risk.
Political risk, good governance, who's on
Yeah.
their board, their
That's
environmental
part-
track record. all of those
Absolutely.
things.
You're absolutely right, Justice. You're absolutely right. In fact, that's part of the risk of the investment. Is stable, if you have a stable country
Mhm.
with little political risk, you take that into account. Well, another country, if there's political risk, that adds to the risk premium you want on an investment. The opportunity cost may be higher in that country compared to, let's say, Ontario. And I think that's what you're driving at, if I understand it.
Partly, yeah, thank you.
Are we ready then, Professor Mintz, to move on to your slide 13?
Yes. So the lease and bonus payment. This is a different case. This is where rents are actually collected. If the government ends up auctioning leases to be given up. And I'm not, I'll be honest, I don't know the Ontario leasing system very well. I know the Alberta one extremely well. In how it operates. But it's quite interesting, actually, when the government puts leases up for auction, companies will actually have numbered companies that will make bids on the leases because they don't want to tell their competitors that they're interested in the property. So you never know who's actually bidding on a lease because that's being done by a numbered company. And then the company that puts the highest offer on the lease gets a lease and the right to extract the resource. And so if you have an auctioning of leases like that, which is kind of typical in Western economies, then you end up getting the government ends up actually picking up rents that way. But this kind of rent is different than the mining profit, or let's say trying to tax profits later on. And the reason is that it's a way of collecting economic rents on an ex ante basis. In the sense that you're doing it at the time you have certain amount of information and you're putting value on that property at that point based on that information. And that information could be wrong. I mean, it's very hard to predict everything in the future. So what you do is you based on all the risks and everything else about the future, sorry. You end up, you end up making a bid based on the information you have today. And you could be wrong.
Mhm.
And I've seen that in the oil and gas sector where somebody puts a bid on a lease and ends up later on, that lease has no value because it turned out there was nothing there to, that was cost efficient to extract. In other cases, maybe the rents, you know, things even turned out better than they hoped. And so they actually do quite well, and they do make a good return, even better. They get ex post, they get more rents than they would have expected at the time of ex ante. And in fact, it's interesting when you look at governments around the world today, they have really both types of mechanisms to collect rents. One is through the lease payment system, or the bonus payment, as sometimes it's called, which is a way of collecting rents ex ante. But then they also try to collect it ex post through royalties and these other mechanisms of collecting rents, even though the other ones aren't as perfect in collecting rents as the auction system. And I'm mentioning the auction system because we'll get into that with Spectrum, because that's an example of collecting rents.
Can we then move to your discussion of the difference between a royalty and a tax?
Yes, so this is a bit navel gazing in a way. Because, but there has always been this issue about, you know, what makes a tax, and what makes a tax, what makes a government source of revenue a non-tax revenue. And it's very interesting that actually when the OECD does their classification, and you know, and I'm going to be basically referring to them here, is that they look at royalties and lease payments, those types of revenues, as non-tax revenues. And why do they call them non-tax revenues? Because it's kind of like a user fee. It's a firm that's going to be paying for the right to extract resources that are owned by the government. And so that's why they get listed by the OECD, not as a tax, but as a non-tax revenue. And because it gives them the right to exploit the resources. Taxes are non-requited payments, kind of mandatory payments people have to make without an expectation to receive a benefit, which is the concept of taxation. And the corporate income tax is an example of a, you know, of a tax. You know, companies pay the corporate tax, but they're not getting a payment associated, or sorry, a benefit associated with that payment. They may indirectly get it, you know, through infrastructure spending by the government or other things, but there's not a direct benefit associated with the payment. What's very interesting about the OECD is they actually classify mining profit taxes and logging taxes as taxes, not as royalties or as non-tax revenues. And so it almost gives you the feeling, well, maybe they're not resource taxes because there's not a benefit being received. Personally, I think that classification is wrong. I think one should actually look at mining taxes, logging taxes, any specialized taxes that, in a sense, give the right to exploit the resource. Should be part of should be a non-tax revenue, or at least or a payment for the right to extract the resources. And both Mr. Hutchings and you know, and Professor Stiglitz have argued that they would be resource-related taxes. I agree with them that they should be resource-related taxes. But I'm raising this because it's actually very important to think about, you know, about what is a tax. There's always been a debate about where you classify taxes, and the OECD does it in such a way that an expert could come along and say, well, actually, mining taxes are not resource taxes at all, which I don't agree with that view, but that view could be given. Spectrum revenues, I would probably classify them as non-tax revenues, you know, as I'll get into it in a moment. maybe we'll go to the next slide, number,
Sure.
is it,
This one?
15, right? So here I'm going to make, 3 colorful points. Sorry for the.
Got it.
It's a pun. Anyway, I couldn't resist. And I'll start with the orange one. It is possible that you could have a zero rent base. And it can happen where, and the illustration I gave earlier on with the stumpage fees, that if you set the stumpage fees so high that it chases away investment, then there will be no rents to be subject to tax. So, you know, you have to design your resource taxes carefully that you don't completely chase away investment.
Presumably, if there's no investment, there's no revenue at all.
Exactly.
Okay.
Exactly. In fact, if you don't have labor and you don't have capital, in other words, the other inputs, not just and management, you know, this, which I also argue is fixed supply, and this could be a source of rents. If you don't have that, if you don't have those, you'll have no economic rents either.
Mhm.
You have to have in other words, you have to have scale. And of course, the larger scale, then the more rents you may potentially have. So that's the first point I wanted to make, just to emphasize that. The second point, which is the brown one, is that risk is not easy to value. Risk is quite difficult, and it kind of goes back to the question you asked earlier on, Justice. You know, we could think of maybe for a minute a riskless interest rate, which might be kind of like a government bond rate, you know, like Canada bonds, because you can trust that you're going to get your money back. The only thing that might be there is inflation risk, because so if you get a short-term bond, you're probably dealing with inflation risk. But you know, when you talk about risk, you know, there's financial risk. There's the possibility you may not get your money back. But then there's also another. There's also other risks that could affect the opportunity cost of equity. Things like political risk that we talked about earlier. But there's also technological risk. You know, to give you an example, and geological risk. You know, when you're trying to develop, let's say, mining, and the ore is in the ground. Well, there's not all ores are the same. There are some ores that have a lot of the, let's say, gold that's right, you know, or zinc or nickel that's right in the ore. And that's a really good deposit because it's cheap to develop it, because you can take out a certain amount of ore and you you extract the particular metallic metal or metallic mineral, and then you can sell it to the market. But some ores may just have a little bit of gold in it or a little bit of zinc, and then it's much more expensive to develop, and you have to get a higher price. And in fact, it may not even be worth it at all. So that's another kind of risk that's involved in it, and that doesn't get captured easily by financial risk per se. And then there's other types of things. There could be, other risks. Let's say you're in a country with a bad rule of law. In some of the countries I've worked in, I can say that. That actually adds risks on too. So when you talk about the opportunity cost of equity, the risk premium you need over and above that riskless interest rate that we might think of as the one without any risk at all, could vary by jurisdiction, and it could vary by even the location where of the type of ore that's in the ground and things like that. So those risks as well. So in a way, not everything is exactly the same. And even when you try to measure the risk premium.
Okay.
So that's why it becomes very difficult to try to actually get an estimate of the opportunity cost of equity. And the economists try to do it using, financial theory to basically measure financial risk, but it doesn't necessarily capture all the risks, that are involved. In fact, even one of the risks could be governments changing policies, like raising taxes during the booms and lowering taxes during the bust.
There could be all kinds of things.
Exactly.
I mean, I'm thinking of so long ago when, some drug on the market, some over-the-counter drug got a bad reputation for some reason. And the products produced by that manufacturer were overnight decreased in value.
Absolutely. And that's
That's hard to estimate.
very hard to estimate. Those are very hard to estimate. So, and then the third point, which is the gray point, which may show my age, but anyways, the expected return. What I mean by the expected return is that people will look at the stock market, for example, and they might look at kind of like the average return you get on your equity over time, over a number of years. And you say, okay, it's 10%. And in the future, I should, at least in the long run, expect a 10% return on my shares. And but that includes risk. In other words, the expected return is really, it's not the return you get net of risk, the cost of risk. And so let me give an example. Let's say you have a bond rate of 3%. And let's say your long run, your expected return on equity is 10%. Well, the difference between 10 and 3 is 7%. Now, people will often hold both types of assets in their portfolio. They'll hold some bonds and they'll hold some equity. They don't necessarily go to the extremes, like one or the other. And that's because they worry about risk. And they view that as a cost. So they kind of want to diversify their portfolio and do things like that. So they're holding both bonds and equity. And really what that 7% risk premium is reflecting is the compensation you need for taking on that risk. And so in that case, once you measure, you can't, I think the point is that when you measure economic rent, you want to subtract out the risk costs in order to get the pure economic rent. But as your example gave about the drug, that could be very, as we can see, that's not an easy thing to do. Maybe we'll go to 16.
Well, sorry, so maybe the bottom line of all of that is because it's so hard, people diversify their portfolios and spread the risk.
Right, they spread the risks through diversification. But my main point is that when you're talking about an investment that goes on in an industry, and trying to measure the opportunity cost of capital in order to separate out economic rent, because we're looking at this profit. And you say, okay, we get an expected profit over time. But that profit, it includes compensation for risk. So you want to subtract out the risk cost to get the opportunity cost of capital. But measuring the risk cost is not a simple matter because there's all sorts of different risks involved.
So Professor Mintz, then, if I understand correctly, you're explaining that chunk of money we've been calling economic rent. And you're explaining that figure of, in your examples, of $100,000, for example, of economic rent can actually be made up of other things, or there are other factors that influence it. Am I right?
So economic rent is purely the surplus after the opportunity cost of using all your of your different inputs. But part of that opportunity cost is risk. And so, and that's not easy to measure. I'll come back to this later, but that's not easy to measure. And so the point is that just looking at the profit rate doesn't tell you what the economic rent is, because you need to separate out the risks properly.
Thank you. So I see you're now ready to move to Spectrum.
We go to 17.
Would you like to start on your slide 17 and
Yeah,
tell
I'll
us
just go ahead.
about Spectrum?
So the one federal revenue that I think is relevant to this case is electromagnetic spectrum, and it's relevant because people have understood that it's in a sense a natural resource, although it's, as I'll talk about later on, you can also call it a public resource which I'll try to make more clear. And spectrum, electromagnetic spectrum really allows for communication of information through the electromagnetic energy in the form of radio and light waves. And governments in the world have been charging or been managing spectrum because it's, there's a certain amount of spectrum that's available. And if you get too many people using it, you can get congestion. And so they end up licensing, the use of who can get a certain radio wave to use in order to communicate. And in fact, in 1999, the government of Canada started auctioning spectrum, which, as I mentioned it later on, is an ex ante way of trying to collect economic rents from spectrum. But when they do when they auction spectrum, it's actually not that simple, because you're putting out a person is getting a license to use a certain wave, but it could be in all sorts of places, multiple blocks. It could also be in for a number of different things at one time, and frequencies, in other words, frequencies. And so it's not, and as I'm going to talk about later on, it's not easily tied to what we might think of as land or geography in that sense. The other thing that's interesting about spectrum, of course, it's international. Is where it becomes almost like a public resource. And in fact, what's really critical is that governments have to work together internationally on spectrum policy and to try to coordinate, the management of spectrum at the international level. And in fact, the Canadian government has that role, it plays that role in a very important way. And it conforms to the international radio regulations that has been established by the International Telecommunications Union. And as I'll give you an example in a moment, but spectrum, you're gonna, but there's a good reason why it has to be international too, and probably I think, Justice, I'm sure, you know very well about satellites and how they play a role in communication today and things like that. So on page 18, which we can go to, I just want to go through kind of the characteristics of spectrum and why it ends up being regulated in some way. First of all, as I mentioned, actually spectrum, it is a natural resource, but it's also a public resource in the sense that it's not owned privately, but by the public. And in fact, in principle, it's actually not owned by the state either. And let me give you an example. The very first electromagnetic communication was due to Marconi in 1901, if I recall. And what he did is he set up a transmitter in Cornwall, England, and a receiver in Newfoundland on Signal Hill, which is always fun to visit. And he was the first person to be able to use spectrum to communicate from England to Newfoundland. But who owns the spectrum? I mean, it's the spectrum is it's being used as, or the electromagnetic wave starts in England, goes across the ocean, and ends up in Newfoundland to be received. So it's in a sense, there's no one owning that per se, which is why you get all this international cooperation today on spectrum, because there is no real country that owns all the spectrum in the world. And of course, when you go up into the stratosphere with satellites and signals coming down, clearly there isn't a clear notion of ownership of that, and that's why it's been called a public resource by some of the experts that are more expert than I am in this field.
In trying to understand this before, I thought, is it any different from those areas of the sea that through international cooperation, countries say, this 15 miles out, we, Canada, will control, and different countries name those limits, and don't they do the same for airspace? For instance, allowing countries to fly in their airspace as if they own it, they regulate it. Is Spectrum any different from that?
No, it's a very similar concept.
Okay.
In fact, to give you the C one, there's a paper I did with Richard Bird on Article 82. And it goes to the exploitation of oil and gas and mining deposits that are off the continental shelf or beyond the 15-mile limit. It depends on, countries all have their different definitions of what the boundary is, right? The United States is different than some of the other countries. So I think we use continental shelf, if I'm correct. So when you go beyond that, the question is, who has rights to the minerals? And who has rights or to the oil deposits that might be in the high seas? And in fact, that's been a huge issue dispute. I can tell you in Africa, for example, some of the African countries like Nigeria and in that area, there's some deposits that are possible to develop through offshore drilling. And there's a dispute about who gets ownership to that. In fact, it also happened in the Mediterranean between Israel and Turkey about who gets the ownership of. In fact, there's a dispute right now over one natural gas deposit that it's a specific dispute because it's in the national. It's not in national boundaries per se necessarily, although some people dispute where the national boundary is. But the main point is that you do get exactly the same sort of problem with air, and you get exactly the same problem with with water, which is not owned by any state per se. And so then you get governments that have to kind of work something through. So that's the first point. It's a public resource, and the second point is that spectrum is not really bound by geography. I mean, it's everywhere. Electric waves subject to technology can go relatively long distances, as we've seen with satellites. Waves, we end up sending signals up to a satellite way in the sky, and then it comes back down to Earth. As an example. Also, the interesting thing about spectrum, unlike natural resources in the ground, like mining or is not depletable. It's always there. You can use it, but after you're finished using it, it's still there. So it doesn't deplete. It's also not depreciable. In other words, you can use it many times over and it still has the same, let's say, ability to handle the next wave just as it did before. It still has the same strength and everything else. So it doesn't depreciate in any way. And then finally, if demand is insufficient, or let's say if demand is less than the supply of spectrum, in other words, all the radio frequencies and things like that, you really don't have a value to a rent value to spectrum because there's too much available and people don't need to pay, or they can get their own frequencies as they want. The issue becomes when demand becomes large enough relative to the spectrum that's available, that then governments have to manage it in some way. And that's when you get scarcity and you get a value associated to spectrum, which is why it's been called a natural resource. That same thing would happen to air. If we had limited, the availability of good air became very limited and people had to, wear masks and things like that, we might start allocating air for a fee, as a result. So, it's kind of a weird example, but who knows down the road, right? In today's world. Maybe we'll go to 19.
To slide 19 now.
So slide 19, so the King government, prior to 1999, it didn't auction spectrum. It used to do what's called a comparative review and looking at the frequencies and strengths and where it's being used to try to put a price on it, without trying to auction it. In 1999, they went to the process of auctioning spectrum, and they've had 14 of them, and 2 of them did not involve the Robinson Treaty territories. Now, what's the value? Now, when the government auctions spectrum, how, what do people put on the value in terms of spectrum? Well, it's really your ability to get use of that frequency. And that will, and the value of that will depend on how many people they can connect to the spectrum. In other words, use it, which they could communicate. So you can think of it, kind of like Bell or TELUS, when they're buying spectrum, they're thinking about their users and their ability to use the spectrum. And so the number of people using it will matter. Population density matters. The value of licenses in the Greater Toronto area, where you have much more density, is higher than it will be in a, in an area where there's not a lot of people living, because you have a lot of users that are in the Greater Toronto area, and you can actually use some radio frequencies that don't have long distance, but you can really get a lot of people onto it, and of course, advertising and everything else follows.
And users generate revenue.
And users generate revenue through the fees that they pay. Then multiple blocks will matter too, because often the larger companies, they'll try to buy many blocks altogether in one license of spectrum, and that goes to
Scale. Is that scale?
yeah, well, scale. It's actually a concept. Actually was one of the areas that I've worked in. Economies of scope, and the idea is that you can provide services more cheaply if you have a whole bunch of things that you're servicing at one time, versus trying to serve, trying to service them separately. To have an example, we lived in Brussels at one point, as I mentioned, and if we wanted to go shopping, it was one of these market areas that you can go to, and you can go to your meat store, and you can go to your bakery and things like that. And I'm going to all these different stores, around the market. But I'll tell you, it's not as efficient as going into, let's say, Alberta, we would say Safeways, but in Ontario, let's say, Sobeys or whatever, and where you have everything that's right there. And the point is that the grocery store can offer a whole bunch of products with much less space and maybe fewer people involved than having 20 different stores offering each product separately with their own space and their own people managing it. And so economies of scope, that's the same thing with multiple blocks. It allows you to use the same, let's say, one transmitter to send out signals to a whole bunch of people all over the place, and having license with multiple blocks where you can get a large number of users that way. So it's better to have one person getting multiple blocks. It'd be cheaper than having N people getting N blocks, instead. People go on. So now actually.
Now we're looking at slide 20.
Yeah, sorry, slide 20. Innovation, Science and Economic Development, which formerly was Industry Canada, has estimated the value of spectrum licenses related to the Robinson Superior Territory. Now, they were actually asked by Justice to do that because they don't have a model to try to say where spectrum is attached to which particular jurisdiction or which area of Canada. Because in a way, spectrum is all over the place. And of course, the source, the origin and the source of communications could be in quite different places. And the question is where does it belong to, and all that. And so trying to estimate the value, what the spectrum license is that a person is buying, you need to do a special study of, and that's what they did for Justice Canada, because they don't normally do that. And so what they, because value spectrum is not related to geography, its value is imputed to the Robinson Superior Treaty Territory by calculating the proportion of the population coverage to total population adjusted for wavelength. Higher wavelengths is more valuable than others. And this is explained their methodology. And basically, I've noticed all the experts are using the ISED calculation, so I don't think there's any debate on that. And so the numbers are that they've calculated for 1999 to 2021. There were actually two. They originally had two reports that they gave Justice. The first one was, if I recall, was in
It was in February.
February. I was
2021.
about to say March, but February of 2021. And then they did another one in October, I think it was 2021, because they had an auction in June 2021. So they added in the June numbers. And if we go to page 21, this is the numbers that they calculated, $43.3 million that would be based on this methodology, would be attributed to the Robinson Superior Treaty Territory. But there's two, and in their own report, they do talk about two cautions, and this goes to page 22. There are two cautions that I think are really important. First of all, they didn't take into account population density in their methodology. When I reviewed it, and they do talk about that. And as a result, they may be overestimating the value that would be attributed to RST as a result, because the population density in the territory, the Superior Territory, is of course much less than you get in the urban areas like the Greater Toronto area. And the other issue is that when you have large geographic areas, which is the case of the RST territory, they assumed you had the same service costs there as you would have in Greater Toronto area, which obviously doesn't make sense. And so they probably overestimated the net value to RST because the service cost would have been much larger in the geographic area. But they can't do much else, because what they're doing is they're looking at a total license and trying to attribute what the value of that license is to specific geographic areas where spectrum isn't tied to any spectrum geographic area. It's a very difficult thing to even try and do, and which goes back to the question of what we're trying to achieve in the first place. We go to page 23. I'll be brief on these. There is non-auction revenue that is collected by the Government of Canada, and includes revenues related to broadcasting, compliance certificates, professional and amateur operator certificates. Some of these are strictly services, where I think you can make the argument that the payments are not made for rents, it's really being made for a service that's being provided. And that's the case of, for example, professional amateur operator certificates. It's to make sure people have the training that's required. So they took out certain types of revenues from ISED did in their analysis. And again, they didn't have a number to that say, oh, this belongs to this part of Canada, and another part of this revenues belongs to another part of Canada. They don't have that number because they can't, again, because spectrum isn't tied to geography. And so then they basically assumed, they just took the proportion of the RST population to Canada's total population, which again likely overestimates the value that would go, especially because you don't have as much density and et cetera. And they estimated $26 million in revenue, cumulative revenue, 1999 to 2020 years. I should mention that none of these numbers have been carried forward to the 21. There's no, because that was not something that was asked of us to do, was to look at. Then there's management costs, which is on page 24.
24.
Is slide 24. And management costs include research, frameworks and regulations, inspection, training, compliance, enforcement, etc. And I said, did something which I liked, which is to try to get direct costs, but they also didn't include, they didn't forget about indirect costs. The corporate overhead, shared IT services, cost of maintaining accommodation and the spectrum management system. All these things they included in their estimates of the total costs. And those total costs added up to $12.3 million on a cumulative basis over 1999 to 20 years. Anyway, given I noticed Mr. Hutchings has used exactly the same numbers. Nobody is questioning the ISET numbers per se, or is trying to change the methodology, even though there are some weaknesses in the methodology. Oh, I forgot to mention that the management costs are split up just like the non-auction revenues according to the population in the RST territory is relative to the share of Canada's population. So this gets me to, I think, more the key point. There's no difference between Mr. Hutchings and myself on those numbers, even though there are some issues, I think, in terms of whether they're the best numbers possible, unless one was able to do some much further work on this. But I think we have to go back to the original question, which is, should spectrum be included at all as a resource revenue that belongs to the RST territory? So I agree with Professor Stiglitz. And
Now we're on slide 25 of your
yeah,
presentation.
oh, I didn't say that. Sorry. Yeah, 25. My apologies. So Professor Stiglitz and Mr. Hutchings and we don't disagree that spectrum is a natural resource. The question is whether it is tied to land or geography. And that's where we disagree in the principle. And in fact, Professor Stiglitz and Mr. Hutchings, and I'm going to quote them, stated in their January 31st, 22 report, that spectrum rights are tied to the ownership of land because the use of spectrum rights requires one to build towers for the spectrum. They slightly amended that in their SIR reply in October 31st, 2022, to say that spectrum license is inextricably linked to the land over which the auction for spectrum rights applies. And I find that interesting, and this is where I disagree with them. In fact, I agree really with what I said themselves, which I took off their website, which they said radio frequency spectrum is a natural resource. So everybody agrees it's a natural resource, no question about that, which is not contained by regional or national boundaries and whose exploitation is therefore contingent on an efficient and effective body of policies, rules, procedures, and practices designed to accommodate as many users as possible and to facilitate the equitable sharing among users in an environment from harmful interference. But the main point is that which I agree with what I said, is that it's not contained by a region or national boundary. And that's the problem of trying to even estimate what revenues belong to a specific area of Canada or even the world. So maybe we'll go to page 26. And we can ask and just go back to how spectrum revenues are determined. And so spectrum revenues come from the sale of licenses, which I've gone through already, and multiple for specific purposes and multiple geographic boundaries. And radio frequencies bands vary according to the information they carry and the distances they travel and how effectively they penetrate. So when companies are buying spectrum, they're trying to buy certain types of radio frequency, depending on what use they plan to make of them. So there are two resource rents that are involved with spectrum. One is spectrum itself has value, as a resource. But as I kind of gave in the Marconi example earlier on, it's in the atmosphere between England and Newfoundland. To say that it belongs to a geography is incorrect. But rents do arise from regulation to prevent congestion on the use of waves. And that's a key point to it. Then there's rents associated with the land that the terminal might sit on, or in the case of where the signals are sent from, the terminal where it's sent from. And so and there's no question that land has value upon which the terminal sits, just like a building or an airport or a pipeline, things like that. They all sit on land. Land itself is valuable, and in fact, businesses have to pay for that land, or they pay rent for that land. And so there's no question that the land itself and the value of that land will be more as a result of more activity on the land that drives up the value of the land. And so you get a rent associated with that land. But you could actually argue that spectrum is almost like a regulatory rent, because if the government wants to really get a lot of auction revenue, it can limit how much spectrum could be sold. In fact, Canada's done that. In fact, a study I found, which I've quoted, has the auction price in Canada for spectrum is 400% above the average OECD auction price. So if the government wants to actually get more revenues from spectrum, they can restrict how much spectrum can be sold in the market, and of course they can get more auction revenue as a result. So it is a regulatory rent in that sense, because the government can choose how much spectrum can be available. And as I said, when demand is more than supply, that's what creates value to the spectrum as a result. Maybe we'll go to page 26.
I was just going to say, Professor Mintz, that we're coming up almost to the lunch break, but I see that you're almost finished with spectrum. So perhaps if you could take us through the next two slides and then we could break for lunch.
That's okay.
Very good, thank you.
So we're on slide 27 now. If you could take us through that.
Okay, so slide 27 and 28, just to show you, I have a little bit of ability with PowerPoint. I thought it would be interesting to show that actually even now today, terminals, especially in areas where you don't have a lot of people living, may no longer be necessary. In fact, Starlink, Elon Musk's Starlink, and there's a new one that's coming that I just read about, but I forget the company that's doing it. It doesn't use broadband or putting wires on, anything like that. It now it links spectrum to a satellite dish that's sitting on a house, just like if you get Bell satellite television, you put a satellite on your house. I had that once. It was a bit of a pain in the neck, but you could put a dish on a house now. And in fact, you don't have to have the kind of more the other alternative in order to develop your communication systems. And as we know, actually, Elon Musk's technology has been very important in the Ukraine lately, because the Russians were destroying the infrastructure for communications with their missiles. But because of Elon Musk's Starlink system, which has satellites that go around the world in the lower part of the orb of of the atmosphere, it picks up signals and then transmit it down to these dishes that might be sitting on structures and things like that. So even that is starting to change. And I just came across an article in the Indian Times. Apparently, they don't know how to value the spectrum yet, or even auction it. So India is maybe the first country soon to start auctioning this type of technology for communications. But they were saying that they're not quite sure how to handle the different frequencies yet in order to do that. I thought that was kind of interesting to add that too. But the main point is that this technology kind of shows you that what's really important is spectrum that runs through the air as a result, which gets to page 28 in terms of spectrum in the atmosphere. And again, this is why I think spectrum should not be included as part of the natural resources that you may think are tied to land and water, which I do think should be included. Is that first of all, satellites travel way above the RST territory, and I guess there's a question: when does the air way above belongs to a territory? I think that's an interesting question. And it's been kind of argued that, especially when it comes to outer space, that's common property to humankind. By the way, that's also been referred to as the oceans that go beyond the territorial limits that the countries use. That's also property that's common property to humankind. As it's been referred to. Then there's signals that come from satellites that are not attached to the territory, and because they come from other territories. And in some ways, I'd like thinking of spectrum like air, the same issues around air. Although air has no price because of its abundancy, but it would be priced if we did have an issue around it. And in fact, there is one example where there is some regulation in the use of air, and that's in the airline industry. And that's the air traffic control system, that NAVCAM runs in Canada. And because we don't want airplanes to, as they're going through the air, to start crashing into each other. And so there's limits put on them on the use of air. And they pay a price for that. In fact, they pay a fee to NAVCAM in order to cover that cost. But it's a service that they're
But
getting.
it's more than regulation, isn't it? Don't countries assert jurisdiction over airspace and say you cannot fly in here? It's not
Yes,
just a
it's-
regulation by NAVCAN. It's an assertion of jurisdiction, just like, I think, but I don't know, assertion of jurisdiction over the seabed,
Yeah, around their
around their
territory.
territory,
Right.
around their shoreline.
Oh, you're right. But they can't go too far above, right? I mean, airplanes go at a certain altitude,
Right.
so they can restrict flying over them because they may be concerned about certain things. As we know, over the Russian-Ukrainian war now, airplanes are flying around,
Mhm.
Russia now. They're not going through Russia anymore, so trips are taking longer, things like that, because of the war. So there are restrictions, and you're absolutely right. There are restrictions in that sense. But when you go way up, like where the satellites are, no state has control.
So the limits on the assertion of jurisdiction are the limits of enforceability.
Yes. Actually, that's good. I didn't think of that, but it's good.
Which may change.
And that, who knows down the road, especially satellites way up in the atmosphere, if we start getting into congestion or even worse, maybe even satellite wars, right? Now, ownership of land hasn't given rights to ownership of all the air above, right? But it does give you can make an argument that, air just above land could be relevant to the land itself,
Mhm.
especially, if there's, if it, let's say you have structures that are on the land, and the air between the structures are relevant because you might want to be wanting to enjoy the land,
Mhm.
the atmosphere around you and things like that. So sometimes there may be enforceability around issues related to that. And then when you think about a terminal, and as I said earlier on, it's somewhat similar to the concept of, natural gas distribution lines and or even pulp and paper mills that are sitting on land and do we start including all the value associated with them as part of the natural resources tied to land. So just because the pipeline is sitting on them. And so I guess, it gets to an issue about how far you go down the road. And so that's the reason why I viewed that spectrum really should be, it is a natural resource, but it really doesn't belong to geography per se. Technology is changing a lot. In fact, it's even getting less connected to geography today, and therefore it shouldn't be included as a natural resource that's tied to the land. And
It might be a good place to break for lunch then.
Thank you.
Actually, before we do that, I have one little housekeeping matter I'd like to deal with, which is I had said earlier, we have a very brief errata of a couple of typos in the report, which we've already shared with our friends. I don't have that many hard copies, but I do have this one here that I'll pass up to be marked as the next exhibit.
Very good. I have been provided with.
You
the-
have, got- okay, great. And I think that is now exhibit 32. Oh. We erroneously have included the Restool style of cause on this document. So you know what I'll do if you're all right with it.
There's
then
no
is-
rush.
Sorry?
There's no rush.
Yeah, I'll bring it back after the lunch break.
All
So
right.
we won't mark this particular version that we handed out.
Okay.
Thank you.
How are we doing for time? It's 1 o'clock. Is 2:30 workable for everyone?
I think so.
Thank you.
Thank you.
We'll break now and come back at 2:30.
All rise. This court will recess until 2:30.